Let's get started. So let me introduce James. James is the CBS alumni from 30 years ago. He's been working in the investment industry for more than 30 years. He runs his own family office now. And today is really for us to have a Q&A session. Like whatever that's practical to you, please ask those questions, especially if you're a J-term student, you're looking for feedback and critics on the pitch, how you want to structure it, what you want to look at for, want to just look at a company, all these questions, and also more career focused questions as well. What's your career like 30 years out of school, maybe, 10 years out of school, 20 years out of school. So let's kick off by giving James a moment to introduce yourself and what's your journey so far, and so people can be familiar with your journey. Is that okay?
Sure. First, thank you very much for inviting me back to Columbia to share whatever information I have with you, whatever insights I have with you. I will say that 30 years ago, Columbia did pivot my life, and I don't think it was essential to the journey that I went on. And in terms of the people I met and the things I really learned. Really more after actually I graduated from Columbia and the class started, Greenwald started, and I would sneak back as an alumni back into the class and learn a lot of stuff. Let me describe, what I do and my ambition for this talk. I manage a family office. Haven't had a client since 2011. Started my firm in 1998. I graduated from Columbia in 93. So from basically 5 years working for various smart people, then formed my own LP. Never had a lot of clients. So in 2011, there was some confusion about the type of registration I'd have to do. So I said, you know what, I don't want to deal with registration. And luckily I was successful enough in the first 13 years that I didn't need anyone else's capital. So I just returned all the capital, and basically, I work for my family for free. There's still, you're only allowed to be an LP if you're a family member. There are no fees charged. The expenses are just divided equally. There is a K-1, but there's not an audit. So my ambition here is because I am a judge at the Artisan competition, and the presentations stylistically are very good, but I felt that hopefully this lecture is just a supplement to your applied value class. And if this works well, I'm going to reach out to the other judges, and if it's acceptable to the Columbia students, investment students, perhaps they can do the same thing and have a series of 3 or 4 or 5 lectures a year. So it will supplement what you're learning in your value classes. Now that said, I've never taken the applied value class. I'm not quite sure how they approach it, but I do know from being a judge, it's like, well, there's a lot of stuff that you don't need in your presentations, in my opinion. In my opinion, less is more. Either it's a compelling argument in the first 30, 40 seconds, or it's like, it's a quick no. That's just me personally, that's my style. And I have some filters, obviously, after 30 years in the business, that I very quickly can tell you if it's interesting or not. So, but it's open Q&A, and so we can just begin by anyone asking questions. There are like 5 questions here that Alex was nice enough to send to me first. But before we get to these, are there any questions about my introduction or my background?
Hi, can you hear me?
Yes.
Hi, my name is Daniel. And I was wondering if you could explain us a little bit about your portfolio, like how many companies do you usually hold in your portfolio, and maybe what's the strategy you use, like in general terms.
Well, that's a very good question. I'm not like most asset managers because it's a family office. So I don't really benchmark myself to the S&P 500. The only benchmark I have, although I'm very cognizant of how I do against the S&P 500 over a long period of time. And by the way, over the last 15 years, I've underperformed, but over 25 years, since 1998, I think my net return, again, I charged a fee for the first 13 years, is around 15%. So if you adjust that 15% for the fact, if you gross it up for the fee, that's around 16 and change. If you gross it up again for the fact that I kept usually 15 to 20% in cash, that means my actual return on investments of the actual picks, it's probably between 17 and 18% over 25 years. I think if you go through the databases of those of people like that, there are very few organizations that have that type of return over the last 25 years. 90% of my gains are long-term, so obviously I'm very long-term focused. And so my only index that I'm really conscious of is beating inflation on an after-tax basis. Because ultimately, you try to if you buy the S&P, it does that too. But ultimately, what I'm trying to do is buy more hamburgers in 5 years than today. And that's the most important thing. And in my opinion, I think people lose a lot of sight on what they're trying to do. Most people are compensated on how much assets they have under management, and that then they start to get more concerned about that metrics, and some of their decisions may be more geared towards gathering assets than. Whereas I try to keep it fairly simple. I try to buy earnings and that are going to be unencumbered by debt, and hopefully I buy those earnings cheaply enough. And sometimes I buy those earnings in really good companies too that just grow their earnings for decades or a decade or so. That's the best scenario, when you can buy cheap earnings that grow for a long period of time. So my portfolio, my largest position is in Google. Again, I'm very tax sensitive. It's 15% of my portfolio. Normally, I wouldn't size anything close to that, but I bought it and, right after the great financial crisis. I think my average cost is like $10. So when you sell that at 145 today, I give up a third of the proceeds to the government. And then I have to lend the government another third for estimated taxes. And so it's a real working capital hog, just on the estimated taxes. In other words, I have to lend the government money for a year to pay 2025 taxes. Let's say if I sold it today, I'd pay $30 in taxes a share and then give the government another $30 as a free loan for a year until I get a refund back in 2026 or something like that, because I would owe the taxes in 2025. And that, you have to take that into consideration on whether you can redeploy the capital, in a much better situation. And so what I recommend, certainly wouldn't recommend putting 15% of your assets in Google at this price, because the upside is probably, in my opinion, around 200. But obviously, the risk is different with AI than it was, 13 years ago, with the portfolio of services they had back then and the competition they had back then. So if it was an institutional account with no tax issues, then it's a different equation. But since it's effectively my money, there's a real question on whether it's worth it, given all the known risks, and there are a lot of known risks now. It's out there; it's pretty obvious. Whether it's worth selling, then and paying all those taxes and then redeploying in something that probably is not as good a business. So it has to be really compelling to redeploy. Now I own some Meta, I own some Amazon. I own 8% of my assets are in energy. I own a Mexican toll road company. I own through Fairfax, India, part of an airport in India. I own like, I don't know, 8% of my assets are in Korean assets from 20 years ago. I own a cosmetic company, I own Hyundai, I own Samsung. I own the Chinese internet companies because they're just so darn cheap. So that's just a wide survey of what I own. Again, I'm buying earnings. And so if you look at how it's composed now, I have like 12% in cash. And if you look at my look-through earnings, then it's like 10 times normalized earnings, nine or 10 times normalized earnings. And I adjust it my way in terms of adding back losses from subsidiaries that are investments and adding back RSUs. So I guess it's more like 10 times free cash flow from normalized free cash flow for the businesses that are profitable. So if you want me to go over that, I can go over that later. So, but yeah, so that's how I do things. And every stock I pick, I have, a estimate of fair value in 2 years. So now we're looking at 2025. What's Google going to be worth in 2025 if they don't get, torpedoed by AI? And it comes around, I don't know, like 220 or something like that, give or take. And so the question is, do you want to ride it from 150 to 220, given all the risk, given I have, huge deferred tax liability and things and things of that nature. So did that answer your question, Daniel?
Yeah. So for, I guess, people that might be new to the industry, what, like, kind of maybe if you can rank in terms of order of importance, would you say the skill sets to pick up in terms of, being able to comprehend financial statements and then modeling, all those various skill sets?
You can learn all that. You're all very bright people. The most important for value investing, it's the ability to suffer, and the ability to take pain, and the ability to stand against the crowd. The ability specifically not to sell Meta at $100 2 years ago. And so, and Google right now, I mean, a lot of people are panicking now and pushing the sell button. So you have to go against the crowd and be not incompetent of where you stand. And so that's much harder. It's much easier for me to do because it's my capital. I don't have, my relatives don't understand what I do, and they don't care as long as they get to make money and get a K-1 in April. So I'm very fortunate. I don't have an investment committee to talk to or to justify myself, and things like that. So it's the ability to take pain and delay gratification. Don't fall into the fear of missing out. Don't fall for all the seduction of the sell side and investment banking and the hype and and I guess the popular stuff to do like Bitcoin and stuff like that. I'm not saying Bitcoin's a bad investment and that's not going to replace gold. It's just that to avoid the manias, like a lot of people are probably investing in AI at or Nvidia, right? I mean, I don't know, it's like what, 20 times revenue, or something like that. And I'm not saying Nvidia is not going to be the next Google/Amazon combined. I'm just saying you have to be really careful not to just be sucked into it. The other thing is, at least for me, it's continuous learning and the love of learning and just the inhalation of information. Charlie Munger's right. You have to love reading, love learning, not just about investing, although, I study the craft of investing at Sunday at 5 a.m. and Saturday at 5 a.m. If you get my emails, you're gonna get them. I think Tonya knows this. You're gonna get them at 4:30 on Sunday morning. That's the type of dedication that I've had, and that's how I survived the last 30 years. So, I'm constantly learning, constantly reading, and not just about investing, not just about companies, but about a lot of different subjects and some like history and science and things like that. And somehow it ties together. So, and so it's that insatiable curiosity that has really, helped me in my journey in the last 30 years. So everyone has a different path. And let me be clear, value investing worked for me. It's not going to work for most people. There were, I think there were 800 people in my class, and there were a lot of successful investors. And they were like, a lot of them did it differently than I did. Some of them were merchant bankers or LBOs or private venture or venture capital. Some of them are growth. Some of them were, I'm sure there are successful day traders out there. Obviously, the high frequency traders are very successful. Renaissance Tech, which is, I have no idea how they do it, but they seem even more successful than I am by a wide magnitude. So the key is you got to know who you are. And one of the things I knew back when I was your age, I knew I didn't want to work for someone else. That's for sure. So, and by the way, I transitioned from IT. My first job was Accenture. And so I purposely went into, that second year at Columbia, every day I was sending out letters to try to get not just investing, but particularly value investing, because I had read Money Masters and The Midas Touch by John Train, which was a lot about value investing and Warren Buffett. So, I mean, I read Securities Analysis and Intelligent Investor, and until Jason Zweig came out with his commentary, I got to tell you, Securities Analysis, I couldn't understand. It was so old. And Intelligent Investor, there were, Mr. Market and margin of safety were very important concepts, but a lot of it, it's like, it was dated even in 1990. But the Jason Zweig edition was excellent, and you should read it.
Hey James, it's Mario. Thanks so much for coming. Looking forward to seeing you in Omaha in a couple months. I guess my question is on Markle, like following up on our email conversation. How do you think about those names that have like an observable book value that, everyone knows what the value is of the assets, but for whatever reason they're undervalued on like market cap basis? Well, and I think you told me you have a position or like.
No, I don't have a position. I have one share in Markel, I have one share in Berkshire, I have one share in Fairfax Holdings Financial. And they're all kind of similar. They all have kind of a similar way. You analyze all of them kind of similarly. These insurance companies, because they're more enterprising. I mean, if it's a typical insurance company like Progressive, it's pretty easy. There are two sides. There's the investment per share, and there's the underwriting operation, and then you got to adjust it for the debt. But you value the combined ratio. Let's say it's a 3%. Does everyone know insurance? Okay, well,
Probably
let's
more
say
than
if your car insurance costs you $100, Progressive is going to make $3 pre-tax on the underwriting side. In other words, between the losses that everyone has plus the G&A is 3%, $3 pre-tax, which is, I don't know, let's say like 2.4 after tax or 2.3 after tax. Plus they have your $100 for a year, right? Which they can invest in that at 5.5% right now. I don't know, call it 5% pre-tax. So let's say they write for every premium, they can write $2 in premium for every dollar in shareholders' equity they have, because there's a limit, right? And so they're going to have $2 of invested assets because they're taking your premium and buying T-bills. And then it's much easier with a chalkboard. I can draw this out, but they're going to make money off the investment side and money off the combined ratio side. And you add those together and you tax affect it. And that's how much that is worth. Now with Markel and Berkshire and Fairfax, they have those two sides. But they also have this venture side, and some of their ventures make money and some of their ventures are still either not going to make money or they're still in investment startup stage. And it comes down to judgment. You figure out where the losses are coming from and whether they're going to actually be able to make money or if it's just a real loss. And then you value the companies that are making money, the ventures, one way, and then you add, if you come up with the value of the ventures, and then you just add it to the underwriting and the investment per share. So when you look at Berkshire and Markel, they always give you an investment per share, right? And so if it's, I don't know, Mary, do you know what Markel's investment per share is?
I think it's like 31 billion. I don't know what that is per share, but it's about like 30% higher than the market cap.
Hold on here. If you just hold on, let me look it up.
I think it's 1,400 a share.
1,400 share. Okay, so if you just put that in a 5% T-bill, which they're much more into equities, but that's $75 pre-tax. Was it $1,400 per share? Did you say? How much was that?
It's
If I
31
remember
billion.
right, it's 1,400.
31 billion on
Okay,
the,
so 5%, everyone, 1,400, so 5% of that is $70 pre-tax. 5% is the 1-year T-bill, right? So they're making $70 on that pre-tax. And then what's their combined ratio across all their premiums? Like just call it 3%. Right? So what's the premiums per share of Markel? Does anyone know? Let me look here. Does anyone know how many shares outstanding Markel has? Okay, they have 8.3 billion in 8.3 billion in premiums. Okay. I'm just looking up the shares. And they have 13 million shares. So 8.3 billion divided by 13, $638 per share premium. I think I'm doing that right. 8,300. Yeah, okay. It's like $630 per premium per share. So let's say they make a 3% underwriting ratio. In other words, after all the losses in G&A, they're making 3% off that, and that's 0.03. That's like $19 pre-tax. So they're making $99 pre-tax. No, $89 pre-tax. 70 plus 19, 89. Right? And then you add whatever ventures, whatever, you know. Well, hold on here. 89 times 0.75 divided by 13. Like they're making like $51 just from the insurance and underwriting operation. And then you figure out what they're making from the venture side. And this is where, again, this is where the judgment comes in. How much of the losses are from starting a new venture and are transitory versus, permanent. We bought the Encyclopedia Britannica pre-internet, permanent loss, never going to see that money again, like newspapers or whatever. And, which companies will make money. And so that's where you would, you'd have to have some judgment and then add up all those ventures and then add it to the value per share of the insurance underwriting operation and the investments. So that's how you do all these Fairfax and Berkshire too. And there have been times I've owned Fairfax and times I've owned in the last 30 years, I think I've owned Berkshire 3 different times. So. Murray, did that answer your question?
yeah, because we were talking about like there's like a 30% haircut on the venture portfolio right now, and it's hard to like value it. But I think.
What do you mean by 30% haircut?
Like the venture portfolio is 30% less than like the observable market cap. There's like a good Seeking Alpha article on this. I'll send it to you. But yeah, it
Well, I
was
mean,
very
maybe it's a conglomerate discount. You don't expect these things to trade at their fair value. So, but if it was really trading at a discount, again, you know, I don't follow Markel religiously, then they'd be very aggressive at buying back shares. And you know, they know what they're doing there. So I mean, one of the things you should compare it to, and this is not an insurance operation, but compare it to Graham Holdings, which also has a huge venture arm to it. And, you know, when you back out the losses of their, you know, new ventures, like, you know, restaurants or automobiles, although those are making money, but they have a lot of new investments. And when you back it out, you know, the stock is pretty reasonable, especially when you adjust it for pension and adjust it for the fact they run with net cash on their balance sheet. I mean, you do the same thing with Google. It's like you want to isolate how much search and services make. And so you have to take out cloud and the losses from Waymo and other bets to get a better idea. It's not just what the gap says. And not only that, but like, you know, Waymo and cloud probably have much greater value than what their current earnings show on, you know, on the financial statements. So, but I don't know. I mean, Tesla seems to be a bit further ahead right now in driverless cars, which is it's going to be, if it's ever perfected, it's going to be a huge market.
It's coming back to the ISC pitches and the artisan pitches that you hear from the school. You mentioned there are stuff that you think is excessive or stuff that you don't really think is necessary.
Yes.
So, okay, a little bit more on that.
Well, at least with my process and my methodology, and I know the other money managers have the same process at the artisan pitch. Not all of them have the same process, but some of them do. It's, you know, you have to have these two criteria in the first couple lines. What's the price to value? Because if there's no upside, just tell me what the value is, what you think the value is. I can look up the current price on Yahoo, right? What the price to value is, because if it's low, I have no interest in even understanding what you're talking about, and what the net debt is, because if it's encumbered with a lot of debt, I have zero interest. Yeah, because I don't know enough about things to know, you know, when September 10th is and when September 11th is. And if you had debt on September 10th, there was a good chance that you weren't going to survive until September 12th. Same with, you know, same with the great financial crisis. So you tell me those first two things, you know, if it's cheap and if it's a strong balance sheet or strong financials, you know, if it doesn't fulfill those criteria, then it's a quick pitch because I have no interest if it doesn't hit one of those two criteria. And then it's like, okay, what's the business characteristics? What's the unit growth? Do they have a real brand? In other words, the definition of a real brand, do people go out of their way to use that service or product? Sports teams have a brand because a lot of people will skip work or school to go to a sports bar to watch, you know, the NC2A this week and drink a lot and, you know, have a lot of chicken wings because, you know, that's the definition of a real brand, to go out of their way to watch an event. You know, the NFL, your team or your Major League Baseball team, that's a real brand. I have to go like 22 miles one way to go watch the Nats play, and they don't even play well, but I do it like 13, 14 times a year, right? That's a real brand. I mean, every day I listen to a podcast about the Nats. That's a real brand. And so why is that important? Because they can increase their product or service with inflation. And that's what I'm trying to do. I'm not trying, if a product or company is increasing their revenue by raising prices greater than inflation, well, eventually the market will seek a substitute service or product for that. That's why you actually, when a company is increasing their growth, when you get a CEO saying we're going to grow our revenue the units are flattish, but we're gonna grow our revenue with raising prices and mix greater than inflation. In other words, the average selling price per unit has gone up for some reason, greater than inflation. That is something that is eventually gonna catch up to that company in terms of losing market share, and they're gonna have to adjust the price lower again. Now, that may not happen for 2, 3, 4, 5, 6 years, but eventually it will happen.
So it seems like when you are looking for investment, you're looking for pricing power, you're looking for quality of the business.
Well, those are the third and fourth, the management, capital allocation management, integrity management, smarts. Those are the third and fourth categories, but the first two, which I did not see in the pitches. This is one of the reasons why I wanted to talk to you guys. You don't have to have more than a one-page tear sheet, really. This is just my opinion. And I want to say this, the couple judges who wrote very good books that pitched the perfect stock. That is Wall Street. That's the portfolio manager. Fidelity probably works very differently than I do. With committees and stuff like that. I just want to preface this just for me. Okay. All I need is a one or two, like a one pager. But the first line better be what's it worth in a couple years. And what does the balance sheet look like? What's the EBIT to interest ratio, if there is interest, And then if it doesn't fit one of those two criteria, then it saved me a lot of time. If it does hit those criteria, if it is cheap and it has strong balance sheets, then I sit down and okay, let's go over this. What is the unit growth? How is management? What's the return on capital of investment? Right? So that's the way I would handle it.
You can follow up on
But again, everyone's different. I mean, I'm sure, some shops have a formal process of writing it up and stuff like that.
follow up on this approach is, this school, or at least the community here, seems to really stress variant view and variant perception. The perception that you have that's different from the market. How do you kind of work that into your investment decision? How do you kind of know that what you look at is different from how other people are thinking about this similar situation?
I don't know if I don't have an information. Are you asking if I have an informational edge? I don't.
It's not really an informational edge, but like the variant perception is like how you view this is different from other people.
I think I think it's the fact that they're measured on a quarterly basis and they have to go in front of their investment committee and justify why they own Meta going from 290 down to 890. That's very difficult. A lot of peer pressure. And I felt it. I mean, I thought Meta was a buy at, 200. I thought it was a screaming buy at 150. And I kept on buying shares, not a lot of shares, but some shares. And, at 120, I'm thinking, what did I miss? Then it goes all the way to 90. And so that's, I sit back here and I think, how is AI going to change my business? Is it going to put me out of business? Maybe. But, and you have, as long as humans touch it, can anyone explain to me how Meta got to 90 without just the basis on fundamentals? It was all variant perception on the negative side. Right? And the same thing is going on with Google now. Now, maybe the time will tell if David Sachs and, the All In podcast and Bill Gurley and Bill Gerstner are right. And I have a lot of respect for those guys. I think they're tremendously smart. And I really appreciate the fact they share their knowledge. But, and when they say something against Google, it really makes me think. So, and then, Ackman's a pretty smart guy too. So, and he, his case is pretty persuasive also. Yeah, I don't know if that made any sense, but I want to be clear. I have no informational advantage at all. I don't talk to CFOs. I don't talk to CEOs. I do, and my brother works with me. He does a lot of the legwork. But we do subscribe to some rather expensive services. But it's but the other stuff is is Morningstar, Value Line, the FT, Wall Street Journal, Barron's, The Economist, certainly stuff that's easy that anyone can get. But you know what's different now than 30 years ago? You can learn anything on YouTube. Twitter is one of the greatest research tools that come about. If you want to know why Google's down 4 points that day, you just punch it up on Twitter and they'll tell you. But you know, you want to learn not so much in small caps, but in the large caps. You want to learn the business model of CarMax, which I don't own. Just go to YouTube or some kind of podcast and they'll go over the model. Right. And so the other thing is, you know, the person asked, what helped me along the last 30 years? Study businesses. Study what makes a business fail, right? What businesses fail and why, so you know how to avoid those. And what businesses succeeded and why. And like, why are Trader Joe's, and which is not public, and Chick-fil-A two of the best retail concepts, best businesses that exist today? What makes them so good? Trader Joe's, it's like more square foot sales than, I think it rivals Costco. And I think I saw something on Twitter yesterday saying Chick-fil-A has $6 million in sales and they're closed on Sunday. Why? What are they doing right, and what can be applied to other lessons? So, and the other thing I'll say is, like, businesses die. 30 years ago, when I graduated from school, the Dow Jones was completely made up. Basically, I would say like 90% of those companies have been replaced or merged out or whatever. They certainly weren't the juggernauts. And 30 years from now, Google and Amazon and Facebook and Apple and Nvidia will probably not be the juggernauts they are today. And, you know, talking about, just curious about things, there's entropy, right? That's a science concept. It's a second law of thermodynamics. It's the concept of things go from the state of organized to disorganized. And, you know, as an aside, that's how time works too. Everything from this point on has infinite possibilities. But that concept is true for companies also, and every organization. It goes from the point of organization to disorganized. So, you know, and so what is good today very rarely stand the test of time.
Along those lines, when you say rating management, besides ROIC, are there any other ways that you evaluate them?
It's more of an art. It's how they, you know, it's the letters they write. A lot of, like, I would say, unfortunately, 95% of the shareholder letters is just a marketing thing, which they tell you nothing. It's you got to read the proxies to see how they are compensated. Like, I own a lot of oil service companies, which are not good businesses, but they're really cheap. And the capital allocation skills are very not good. And when you go read the proxy and you see that they're measured, their compensations based on EBITDA and not return on capital, well, you know, that's your answer. They get paid on building empires, not return on capital. And in an ideal world, I would have that. But, you know, at the same time, they're trading, if oil, you know, goes back to whatever, 120 or whatever, then they're trading at 2 or 3 times earnings. Even at the current oil price, they trade at 5 times earnings, and their balance sheets are pretty strong. That's the one thing they did right since the last crisis, oil crisis. And so it's not a perfect solution, but it's cheap and they have good balance sheets. You know, business is marginal. It's good. Actually, it's good at this price, and it's much better at a higher price, and they should be able to survive an oil crisis. Management is, you know, they don't understand return on capital. I don't understand how they're paid so much money. Well, maybe they do, but they're just not very honest with it in their compensation system.
Following up on that situation, where you kind of balance out your portfolio with really good companies, great management, versus the probably second-tier quality companies with like cheap valuations. Like, which ones tend to work out better, and which
Oh, that's
ones?
easy. The ones that can grow. The ones that can grow are always going to work out better. I mean, value investing has not worked well in the last 10 years, and there's a lot of theories why. Certainly David Einhorn had a theory that I thought was very compelling, but the fact that you only can make money in value investing if they're basically self-liquidating at 5 times earnings. And you're one of the last guys to own the shares. I thought that was very insightful and new. But part of it is like, okay, so I own, some small cap tech companies that in the business service area that in theory should be very good businesses. They measure things and the management's thin and there's a board issue and stuff like that. And I don't see how the stock is cheap. The balance sheet's not that great, but it's okay. But the stock is cheap. And I don't see how they get through their problem. And I like the management team personally. I mean, they're nice people. Versus Google, with all its problems with not even getting George Washington's race right, they have debt. So if Sundar doesn't make it, well, I do wonder what Larry Page and Sergey are thinking right now, because that's the only thing that matters, because they have the voting class. So I don't know what they're thinking, but certainly, I mean, if you want Google to trade at like 250 tomorrow, you put a clone of Elon Musk in charge and he just starts chopping and doing smart things as opposed to what's over there now. And I'm not saying that Google's not smart. My life isn't, surrounded by Google products. My phone, my camera system around my house, all my Wi-Fi equipment. Google makes wonderful products, but clearly they have a lot of expenses they can cut, and clearly they have a political orientation that's unappealing to about 30% of the country.
So interesting you touch upon Elon Musk, like he runs Google, Google's gonna be much higher highly valued. But if you look at Elon Musk ventures, the ROIC generally speaking are not there. But he built a huge business out of it. So how do you kind of view entrepreneurship like this?
Well, I don't own Tesla. I don't own SpaceX.
Yeah.
He's a fantastic, he's the best innovator so far. Better than Steve Jobs. Steve Jobs is also, you just can't replicate someone who built Apple twice, did Pixar. I mean, when you have an executive or a guy who can do well at 2 different things, like the Shohei Ohtani in business, be good at pitching it and good at hitting, it's amazing. And Elon has had 3 or 4 acts, right? And so I'll say this about, I don't know much about Tesla. I own 2 Teslas. That's the only thing I drive. I don't know if I get if it's such a wise idea, because you are concerned about range anxiety and there's issues in the cold and things like that. But I don't know, for the life of me, and I have a lot of respect for short sellers, particularly Chanos, who just retired. I don't, for the life of me, understood the short. And my first job on Wall Street was a short. I was a short seller as an analyst, and I didn't understand it. Here you have a guy who can just merge SpaceX into Tesla effectively. And if they go to Mars, they have all the rights to Mars. So you're shorting a company that can potentially own a planet. That's crazy. You don't want to be on even if it's a 2 or 3% chance that happens, you don't want to be on the other side of it. Plus this robotaxi thing, if it works. So I live about 25 miles away from National Airport. And with the tips in the wrong time of day, like rush hour, it's going to cost me $100 to get to National Airport, because so much of it goes to the driver. It's like 3/4 of it goes to the driver because of the tip, the fee, Uber keeps 1/3 of it. And then, the rest of it goes to the driver in terms of paying for his car, the fuel, and stuff like that. Well, as soon as these robotaxis, whether it's Waymo or Cruise or a Tesla robotaxi come about, that $100 trip is going to go down to $25. And that car is going to have 100% IRR within a year. So that car is going to pay for itself within a year. So the economics are compelling. So if you understood that, why the heck would you ever short Tesla? That's what I don't understand. Valuation, sure, you might have the valuation argument, but geez, those are really open-ended, huge opportunities. So that's the other way. I mean, it's like everyone here wants to be wealthy. I'm sure there have been great short trades like the CDS short of the 2008. And Pershing Square made a lot of money shorting during the pandemic. But in general, there have been billion-dollar short trades. Obviously, George Soros 30 years ago with the British pound short. But it's hard to like make money shorting in the long run. Very hard. Especially if you manage your own money. It's not worth it, in my opinion.
So what's the thesis behind Chinese tech? So like K-Web, the beta vehicle for that asset class is down to like 80%.
They're just cheap with great balance sheets. All of them have net cash. And let me tell you, I've lost money. I've lost money because I own China Mobile and Trump made me sell it in January 2020. And that was the cheapest mobile telecom company in the world. I think it was a 2 times EBIT with net cash. And just to embarrass myself further, I was also buying Yandex, which is the Google of Russia, the day before that was shut down. And Yandex just sold their Russian operation, which is effectively all their value. And I'll be lucky if I get 30% of my money back on that. So yeah, it's playing with fire, but I think, Alibaba is probably trading at 2 times EBIT with net cash. They have issues with Pinduoduo. I think Baidu alone is probably they have so much net cash, and their robotaxi alone is worth the price of the stock. And then you get the search business and the cloud business for free, which are also very good businesses. Tencent I own through Naspers. It's probably trading 30% of NAV, maybe 35% of NAV. So I mean, I'm not sure if it's the best way to make money, but I certainly like owning cheap. I mean, it could be a value trap. It could be, yeah. I mean, maybe it's not dynamic. So, but I own a Chinese railroad company that has net cash. I don't own a lot. It's really more of a novelty position because it's like I don't own that much. Maybe $100,000 worth, maybe 200. I don't remember. But obviously there's a lot of risks. There's a Chinese government risk. You don't really know what's going on. The financials are in a complete language, and even if the financials were in perfectly clear English, Chinese government can do whatever they want. That said, on an enterprise mile, on a miles per share, I'm capturing it at like $12 or $13 million per mile. Obviously, the book value is significantly higher. It's like $60-70 million. They just built the Silver Line in DC like 10 years ago. It cost $230 million per mile. So I'm buying that at 5%. And it's net cash. It's can pay projected a 7% dividend. It's the free cash flow yield is like 11 or 12%. So I'm not saying put a huge position in. I'm saying it's fun to own, right? And that I could do that because it's a family partnership.
What are some challenges of running a family office? And do you have any allocation to VC?
Allocations for what?
For venture capital?
Nope. No venture capital. I buy earnings. That's it. I don't buy promise. I just buy earnings. Now my companies do venture capital. Like, certainly I don't have a huge position in Graham, just a tracking position. But they're always investing in stuff. If you own Markel, they're much more entrepreneurial. There is a German Investco that has not venture capital, but a lot of merchant banking type situations where they buy existing companies that are doing very poorly and turn them around. So, but I just try to make it simple. I just buy earnings. I try to buy them as cheaply as possible without it possibly being encumbered by debt. And you can make, I said before that the best way to make money is Google. I mean, I bought it like my first slug in 2007, haven't sold it. That particular lot, I've sold it off and on a little bit. But you can make money in really bad businesses if you buy them at the right price and you buy them at the top, at the right capital scale. If you bought GM, the debt in 2008, right? Because the equity got wiped out and, you bought the debt at the right price, then, you probably made money on that trade. So like, for example, like New York commercial real estate. Maybe it wasn't as good a business now as it was 15 years ago, but if you buy the debt, because all the equity is going to get wiped out, if you buy the debt to the point where you're buying it at $70 a square foot, the whole building at $70 a square foot, and you could rent that out at $7 a square foot or a 10%, yield, 10% cap cost, you're probably going to make a lot of money. And I'm talking about all unlevered, by the way. So you own the mortgage, the most secure mortgage. It wipes out all the other mortgages. So you own all the building free and clear at $70 a square foot, and then you can just go rent it out at like $7 a square foot. Yeah, you can make money on that. But no, I don't do on venture capital. I don't have that skill set. The only skill set I have is I can do simple math to figure out what the balance sheet looks like. It's just addition and subtraction. And I can do multiplication by figuring out, the valuation, shares times price plus or minus the net debt. And then, I could read the earnings analyst estimates for what they expect to make in 2025. So.
And the first part of my question was, what are some of the challenges for setting up
The family office?
any advice that you would have for someone who is thinking of either joining a family office or starting a family office?
Well, first of all, I guess this goes to my philosophy of what we're here for. The philosophy of why everyone is here is because we want to be free, right? And so that's why I worked for myself for the last 25 years. And the family office was, as soon as I got rid of the other clients, then, that by de facto, I'm a family office. And so I always had a theory, and this is probably not conventional, that if you can make money for other people, you can make money for yourself. And if you can't make money for other people, you're not going to last long on Wall Street. I mean, there are a ton of people who started their business, who ended their career in 2008, and a ton of people began their career in 2009. There were a lot of people who ended their career in 2020. Well, actually, there's been a desert in value investing. So a lot of value investors have ended their career in the last 3 or 4 years because of the underperformance, right? And so, hold on for a second. So the whole idea is eventually to be free. I have a theory that the more choice you have in life, the happier you'll be if your health is good. And, my point, I only have if I'm lucky, I don't know, like 32,000 days to live, maybe only 12,000 days left if I'm lucky, right? I'm not sure what the exact math, but you understand what I mean. And so I want as much choice in that as possible. And that is what the family office gave to me. Now, again, this is just what worked for my life. I know someone very well who, went the other way, worked for other people. Now they're working for him effectively. He was so successful. And, he is much doing, he's doing exponentially more income than I am, and I'm doing pretty well. So, there's a path if you work for other people that if you gather enough assets that you know you're going to do well. So the big thing is, if you don't make someone money or save someone time, you're not going to last in this market. They're going to weed you out. Wall Street, there's just no place to hide. So you got to assess what you're doing every month or every quarter. It's like, what value did I add today? And if it's not clear, in about 15 years, you'll be replaced by someone who got an MBA from Columbia from the class of 2038 or 2039 or something like that. That's how the market works.
You mentioned that you bought Yandex the night before your sanction. And you mentioned that you would be lucky to get a percentage back. So I ended up in a similar position as you did. I was wondering, can you elaborate on why you think you'll end up in a situation where you only get a percentage back, or what's your general view on this whole situation?
Well, they put out a press release saying that they sold their operations to some Russian oligarchs, and you know, the value per share that we're getting back is like $13 per share. I think my average cost was like 29. So the last trade was right before they shut down trading, was 18 or 19. So, you know, I mean, obviously I misjudged how long the war was going to last.
What's your
And ironically, those operations are now worth even more than before, because all the Western competition left.
have a perspective on when the trade will be allowed again? Or the
Excuse
sanction
me?
will be- Do you have a perspective on when the sanction will be lifted?
Doesn't matter, because these guys, I don't know, I'm not on top of the details, but these guys are not going to be affected by the sanctions anymore. I think there's some kind of crazy thing where they get Chinese RMB or something like that. So I'm not really quite sure. So I have no idea on when the sanctions is going to be lifted, but I'm not quite sure it really matters.
I just have a question. Like, did you have any examples of cutting loss and realize like you're wrong? And what is your general pattern of recognizing such mistakes?
I'm sorry, what was the first part of your question?
Like, did you have any previous examples of cutting loss or realize you're wrong?
Oh, I've made a lot of mistakes. Is that what you're asking?
Yeah, and
Oh my gosh, I made so many mistakes.
Yeah,
Particularly in the last 5 years, right? I mean, I was short the VIX back in 2000. I mean, no, down during the pandemic in 2020. That almost took everything out, because my broker changed the margin requirements right in the middle of it. And so the most important lesson learned, I lost $5 million on that trade. The most important lesson learned is don't short. I should have known that lesson from 20 years ago, but it's like, at this point, it's like, I don't need the money, but I don't want why would I ever risk something where the broker could end up owning my house? So, and I like my brokers. They've been very value add over the last years, but business is business, and they lowered the boom, and I said, I don't care how much I lost, just cover the goddamn position, excuse my language. I own Pandora, which is a mistake. Which Pandora, the music company that competed with Spotify, and Pandora was trying to make up for a mistake of selling Netflix at $4 back in 2008, which I think I sold the equivalent of 700,000 shares of Netflix at $4. That was probably my biggest mistake in terms of omission. Of course, I bought Google instead because I thought it had more margin of safety from an operations point of view. But and I certainly probably would not own Netflix for the next 15 years. Given the valuation at times. But because I missed Netflix, I thought Pandora was the next Netflix. And then, they suffered through for 3 or 4 years I owned it. And then I looked at the Spotify S1 and saw that the CFO of Netflix went to become the CFO of Spotify, and that Spotify had more net cash than the market cap of Pandora, or the revenue of Pandora. And I had said, oh, this is over. It's a mistake. And when I bought the position in 2015, I knew that Siri would like to own the property, and they did own the property. Unfortunately, my valuation for it was at 5 times revenue, because that was what Siri was trading at, and Greg Maffei only paid 2 times revenue. So, and again, that was kind of not my typical, that was actually a venture type of investment because, you know, they were burning cash, which is the negative. I usually don't invest in that. But, you know, I could see the potential of because of what Netflix said. I thought that Pandora can do original content, like podcasts and you know, promote up and coming artists. And so they had the vision, but they just couldn't execute. So so that was a mistake. Yeah, those are probably I'm sure I have many mistakes, but those are two of my more memorable mistakes. But you know, my average cost on Alibaba is probably close to like 170, 180. Obviously, it's trading at what 74 today. So you know, that was a mistake. You know, I've owned energy since 2014. I've made money on it, but it hasn't paid off nearly as well as just buying the S&P 500. So what I don't know. You know, in some ways, I think I'm making more mistakes in the last 5 or 6 years, or had more adverse returns in the last 5 or 6 years than at the beginning of my career. Part of that, I think, is the investment universe now compared to then. There are not a lot of business services and software companies that are trading cheaply in this market or in the last 10 years. But back when I started in 98 to 2003, you could buy a lot of really good software companies at less than 2 times revenue, and that's unheard of now. You can buy a lot of good business service companies at 11 or 12 times earnings, right? Which is unheard of now. And now you have to take more risk, like the business service company I own, which is trading at a discounted revenue. But obviously, there's a lot of issues. You know, I own another business service company that is really cheap, and you know, I don't have a lot of confidence in management because they haven't executed. But its competitor is trading. I think this company has like 10% margins. Its competitor has 20% margins. This one's trading at 1 times revenue. Its competitor is trading at 5 times revenue, and it's the same business practically. So one's executing, one's not. And it's just a tracking position because I have no confidence that the manager started the business, owns 40% of the shares, and so that you can't move them. And so let me unplug this. Sorry. And so you know, I'm waiting for some kind of resolution there. So I mean, I have a lot of Korean stocks that haven't done anything for 5 or 6 years. And you know, I don't know what to do because they have strong balance sheets, they're not burning cash, and they're trading at 1/10 their value. If someone would go in there like a young enterprising person who understood the Korean culture and could take out the chairman's shares and run the company properly, they'd make 10 to 1 on their money. So yeah, it's a humbling business, very humbling.
James, quick question. Apart from Google and Meta, any other, you know, stocks among the Magnificent Seven that you are fond of?
Yeah, I own Amazon. I mean, I think it's not far away from its fair price at like 200. But yeah, it traded down well, they were investing a lot in CapEx and they had overbuilt after the pandemic, and so the stock got unpopular. So, but you know, one of the things, like, you should study NVIDIA and Apple and Netflix and all those companies that are in the Mag 7, because one day they will be value investments, I guarantee you. NVIDIA will be cheap one day. Just like Intel 30 years ago was NVIDIA. They were the juggernaut. They could not be beat. And look at them now, right? So you have to study these companies now and ask what could kill them, and ask, you know, at what price would I own this, right? Because every company goes on for sale at some point in your investment career. That even the greats, Apple will one day be a value play. It was a value play. I didn't own it, but it was a value play 10 years ago when it was trading at 10 times earnings and had net cash. I just wasn't smart enough to figure out, you know, that unit growth didn't matter, that they were gonna, you know, get more rent per that brick that you call an iPhone, which, by the way, again, I'm not sure if that can keep you going for a long time, but eventually it's going to catch up to you. So, I mean, iPhone Care, they raise the price of the brick every year. They charge a little bit more for this, a little bit more for that. Unless it's clearly value add, then maybe you don't upgrade the Apple 16, maybe you keep your Apple 13 for another year or another 6 months. So that's our point, but they're all they're all great businesses, and they have management debt, but they also have a lot of arrogance. Like clearly Google's very arrogant at this point in that, and Boeing is currently suffering from that, and so these companies get very arrogant, and so that's a huge challenge for them, and that's why they need someone to come in and wake them up. So, to the court of Delaware and to Elon, I would hope Google will pay you $60 billion to come run Google to make up for your loss that Delaware took away the $50 billion, because it would be really worth it. He would increase that market cap $120 billion in day one.
James, this is Aria from IIC. Thanks for your sharing, and I think you have been in this market 30 years. So my question is, what's the most important things you think survive in this market?
Well, I think that's an excellent question. And it goes back to my point, is like, let's make this very, very basic. We're here to get wealth. And the key to wealth is not how much you make, it's how much you save. And so I would have very modest expenses. I would have no debt at all. So pay down your student loans or whatever loans you have as soon as possible. I have no mortgage. I haven't had a mortgage in 30 years. And even though that's not tax efficient, it doesn't matter. I mean, you don't want to worry. You don't want to be scared out of your position in the bear market. So you have to insulate yourself with layers and layers of a strong balance sheet. Net cash on net cash on net cash, and have a low burn rate compared to that net cash. I think given the interest rates, my burn rate is now lower than my interest income and dividend income. And so as long as interest rates stay here and businesses, and there's not a recession which affects the dividends, even though the drawdown's 30% for whatever reason, let's say interest rates go from 5 to 7, right? Because my companies don't have balance sheet risk in general, the prices will go down, probably 30-35%, but the dividend will stay there and the interest income is going to go up. I'm still over my expenses by, some amount, and I can afford to sit here for 5 or 6 years. So I'm not going to insulate yourself from, if you're going to go in this business, you want to insulate yourself from a drawdown, a meaningful drawdown for a long period of time. And that means having, lots of cash, lots of passive sources of income that are unencumbered by debt, and really low expenses. So, and, I spend a lot of money compared to the 1%, right? But compared to my net worth, it's probably less than 1.5% of my net worth is what I spend. So.
James, so just kind of bouncing off of that. So you talk about having a lot of cash on the balance sheet and a low burn rate. Are there other factors on the balance sheet and also maybe from the income statement, or like just the operations of the primary business, checklists that you go through that are just kind of like high level?
Well, my checklist of buying stocks, it's valuation and balance sheet, and then is this a good business? And again, that's a lot of judgment. Return on capital is really important. Does everyone know how to measure return on capital? So you take the net working capital plus the net PP&E, and that's your denominator. And then you take the EBITA, not DA, but EBITA, and EBITA over net working capital plus PP&E. That's your pre-tax return on capital. And the higher that number, the higher and more sustainable that number. And if they can reinvest that number in new units like Chick-fil-A can with new stores, right? Then the higher quality that business is. So I'm not sure if that answered your question.
not, I don't know if you like, you're just kind of screening things, if there was like a certain inverse of like the treasury yield or earnings per share. Or
Oh, okay, yeah. So, I mean, I think the average business is worth 16 PE. If you take the long, you can look it up. It's like the average PE Ford, only Ford. Trades at 16 to 17 times PE, and it kind of makes sense that because before the great financial crisis, where interest rates went to zero, that the long-term 10-year yield, which every asset is based off the 10-year treasury yield, was trading around 5.5, which if you convert it, it's like around 16 PE, 5.5 is 6 or 7. So the inverse of a 16 PE is a 6.6, which is close to the average of long-term treasury yield. And so they trade off each other. Now the tricky part was in the last 15 years, and that formula broke down because of the great financial crisis. And keeping interest rates at zero and getting rid of the debt that way. So we'll see if that formula holds up. But just so even when interest rates is 0 or 1, I still said 16 PE just to be conservative. I didn't move it up to 20. And so if it's worth 16 times PE, why would I ever buy it unless it's trading at 12 times PE or lower? So
Last
I mean,
question?
name a stock. Who's bought a stock in the last month? I'm gonna embarrass them. Okay, you in the back. What'd you buy?
You won't like this, but I bought Nvidia.
Okay, what's it worth? What is it worth? Don't tell me what the stock price is. I can look up the stock price. What is it worth? What was your method? What was your process in valuing it?
So I bought Nvidia in 2021 after doing some research, and then I bought again this summer, and then I did a case on Nvidia in the fall for value investing class, and I bought again in the fall, and even since the fall, it has doubled. And I think there was a Nvidia developers conference yesterday, where the CEO talks for 2 hours and presents all the different use cases that their new chip and the existing chips can be used for. So there's a lot more growth that we can possibly see right now, and that's the reason.
Okay, so if it's trading at $900, you need at least, let's call it like divided by 25. Because that's a fairly healthy 25 times earnings is fairly healthy for a great business, fairly healthy PE for a great business. Okay, so that's $36 per share that it has to earn to justify this valuation. Next year is supposed to earn $28 and 26. So it's probably only like it probably hit that in like 2027, maybe 2028, so 4 years from now. Plus all the cash that they're earning between now and then. So maybe, I don't know, but that's a lot of growth and that's still a healthy PE. So the question is, would you rather own that or a dingy, terrible, poorly managed, no vision oil service company trading at 5 times earnings? That's the question that people ask themselves. But like, besides the news flow that you justified your purchase price on, where was your gut opinion? Where was your valuation analysis on it?
So the key driver for the valuation in my mind was that they saw their market as a 3 trillion market, and at the time they were only 1 trillion, and now they're close to 2 trillion. There is still 1 trillion of market to capture. So and that's just the knowns. So there is so much unknown. Similar
So
to
$3 trillion,
Tesla.
but that's going to be divided by AMD, Intel, Amazon, and OpenAI. I mean Sam Altman and Google. Plus, why wouldn't Taiwan Semiconductor go to them and say, hey, you know, instead of the 40% margin I'm making, I want to make 60% margin. I don't know. I don't even know if I'm asking the right questions, but those
You,
are,
no, you, I think you're referring to the AI market. I'm referring to specifically chip.
yeah, but the
We're
chips,
driven
the
by
chips are going to be
AI.
substitutable, is my point. Why, I mean, NVIDIA has the market share now. But why wouldn't, you know, Taiwan Semiconductor demand higher margins? Why won't, you know, Google and Amazon and Microsoft are gonna make their own chips, right? Sam Altman wants to get into the business.
Yeah, absolutely, and that's going to take some
AMD
time.
and Intel, I don't follow
Take
NVIDIA
a
at all, but
considerable amount of time.
one of the things I noticed is that they were selling chips to China, right? And the United States, it's in the United States' best interest for Micron and Intel to do well because they're American companies and they have the one thing the pandemic and our rivalry with China showed, we have to bring that fabs, as painful it's going to be, back to the United States as a national security interest. So I don't know. You know, I'm not saying it's not going to go to 1800 or another double or triple from here. So, but
My prediction is that it will, and then it'll slow, and then, you know, it'll become, I feel like it's another Tesla story where there's going to be a huge amount of growth, and now Tesla has hit that crossing the chasm period where it has to cross the chasm, but it hasn't, which is why the stock is suffering. So that might something like, you know, not the chasm part, but something like that would happen. I predict with NVIDIA as other chip makers enter the market, as you mentioned. But for the next few years, I think it's going to experience.
Well, let me ask you a question. Do you think it's going to be earning 60, 70 bucks in 2028 on an annuity-like basis and maybe even growing? Because if you think it's going to be a lot more, then yes. But if you don't, or you have no confidence, that's what I'm asking.
So that would mean that.
That means it's going to be trading at like 13 times earnings in 2028.
Something.
I don't know, but these are the questions I think you should be asking yourself. And I'm not trying to encourage you to sell China. I mean,
No, I appreciate this.
but it's like you have to ask yourself, what does this really mean at $900? How much of this is net cash that they're expected to have in the next 2 years? How much is growing the net cash? And how much does it mean in earnings? So you could look at it, it's like if they make $60 per share, well, 25, what did I say? 25, it's $36 a share. Multiply that by the number of shares, that gets you the net income. Tax effective, that gets you the EBIT. Okay. Say they have 50% revenue. So that's the revenue run rate they have for 36 bucks. Right? How many chips is that? At what selling price? These are the questions that I would want to know. If I'm going to buy something at 25 times earnings. So
I think what the reason for buying is really the things that we don't know. So this is why stocks underperform in my mind, because there are only so many things that we do know, and there's a lot more that we don't know with AI, and I think that there's like all the uncertainty is going to benefit NVIDIA. There are going to be so many more applications of AI that we currently can't even think of.
yeah, they could have said the same thing about radio and airplanes 100 years ago and 70 years ago or 80 years ago, 1920s and 1910s. They could have said the same thing about autos, planes.
Absolutely.
Right. So
Absolutely.
I'll tell you one thing that's going to last 20 to 30 years. Self-moving. U-Haul is not gonna be Amazoned out. People are always gonna move and they're always gonna want a low-cost option, and the lowest cost is self-moving. You know, you feed yourself pizza and, you know, hope that your back doesn't give out. That's U-Haul. So my bet is that under a 50-year time frame, I guess NVIDIA may have a great run the next 50 years. But 50 years from now, U-Haul will more likely be standing than NVIDIA or Google, or even you put Google or Meta or Netflix or NVIDIA or Apple. I would say U-Haul is going to outlast them all. The only one that I think can outlast them is maybe Amazon, because Amazon is basically reinvented the post office. That's what they did.
I'm willing
Really hard to do again.
I'm willing to bet that U-Haul or the company that will replace it will be using chips, NVIDIA chips that will be in their robotics cars or self-driving cars, helping people do the moving. So I'm happy to bet on that.
I don't have to bet on that. I just have to bet that U-Haul, I don't know about that bet. I do bet that the U-Haul brand is going to be around in 50 years. And I could be wrong, but I'm just saying it makes sense that people are always going to move. That's a pretty safe bet to make. And that people are always going to want the low cost option. Now, whether that U-Haul truck or robot has an NVIDIA chip, an AMD chip, or a Intel chip, or some other chip that we haven't heard of, I'm completely agnostic about. No, I really don't care either. I mean, as you as an NVIDIA holder care, or you as an Intel holder care, but you know, what matters to me is that they can get to Idaho to Chicago one way, being the cheapest option. That's what really matters. So, are we up on our time? What time is it?
Yeah, I mean, I think one last question and then we need to wrap up.
Yeah, maybe the last question. Thank you, James. Maybe the last question is for more general. Something otherwise you think is really important for young investors who jump into this market. Is there any general advice?
I did want to go over this because it's important. I'm sure all of you guys are interested in getting your first job on investing, and I can share you with what I did. Because like, again, I transitioned over from IT into investing. There were very few Asians working on Wall Street back in 1992. I had no contacts. My family had no contacts. We were from Washington, DC, government contracting business. And so, what I did was, I didn't go, Fidelity or the major houses weren't going to interview me because I had no experience. There were dozens of people with far more securities analysis experience than I did. And so that's where the competition was. We'll go away from the competition. So I went down to the alumni office and I asked for 3 names who were in value, who were investing. One of them happened to be a gentleman by the name of Don Parker, who had a small fund, whose partner at the time was a young woman named Merrill Buchanan, who became Merrill Whitmore. They were at Value Shop. Merrill Whitmore, if you know her name, now sits on the board of Berkshire Hathaway. I went down there as an informational interview, not a job interview, just an information. You guys as students have a big cachet getting into these places because you're a student. People give you a lot of leeway because you're a student, because they want to share what they know. They want to help students. So you have that key. They're going to talk to you on the phone for 10 minutes, 15 minutes. They're going to meet with you for coffee or whatever to give you the career advice. A lot of people are flattered when they're considered a mentor and giving out advice. And so take advantage of that. So I went down and meet Don. And then I said, hey, here's a stock. I pitched to him. Do you know anyone who's looking for to hire an intern? I didn't ask if I could work for him. I said, do you know anyone looking? So you don't put him on the spot. And he remembers you, or he says, yeah, why don't you try out here or something like that. Actually, I think I did actually ask him for a job, and he was nice enough to accept it. But I wouldn't do that. I would ask if you know anyone who's looking for hire someone. Okay. But then even if they say no, they remember you, right? And you also study what is in their 13F or what they're interested in. And when you come across an article or something that might help them, might save them time, might make them money, might save them money, you send it to them, right? A lot of you guys are getting my emails, or some of you guys are on my email list. You know, I'm sending you podcasts, I'm sending you letters from Fairfax and Markel, I'm saving you time, so you're gonna remember me, right? And so, you know, I got an internship there. They were nice enough to give me their friends list, which took me a year to go through, but eventually I got a job. Now that job, I was started as a short seller. The average salary of an MBA back in 1993 from Columbia was 70 grand. I was only paid 35 grand, and I had to pay my own health insurance, and you know, I had to work from home. You know, it was a bottom floor, you know, studio, and that's how I got started. And so, you know, that's my advice into how to, you know, navigate to this. Don't go where the competition is. You know, make your own opportunity. You know, be very clear what you want and make your own opportunity. Now, some of you have a huge amount of student debt, and that's, you know, that's difficult because you have to make choices. You have to make choices. You have to work for a salary for a couple of years until you pay off that debt, and then maybe you got a mortgage, maybe you got a spouse, maybe you have kids. You know, everything I did, I'm happily married now with 2 kids who are adolescents. But everything I did, it took a, you know, I don't know if I could have done it with a family, because it took so much focus and effort to eventually get to the place where I was free, that I don't know if I had the emotional bandwidth 15, 20 years ago with that. So it takes a lot of sacrifice, but again, that's just me. A lot of people are made up differently. A lot of people have a lot thicker bandwidth emotionally and with stress and stuff like that. Now I have very little stress. Back then I had a lot of stress. And so, but I say, stay away from the, you know, from the Wall Street feeding fest. There's just a lot of fear of missing out with your peers and stuff like that. Go find something else. And when you have it, even if it's a no, then, you know, develop an email list and send them stuff. I remember, you know, meeting, you know, as a student, you know, Tom Russo, right? I hope he doesn't mind I use his name. That was in the summer of 93, right? I'm looking at him, he's up here, right? Now we're peers. Right? I see him at a meeting, we talk, you know, not as, you know, me looking up here, but hopefully, at least for me, hopefully his colleagues, maybe he's still looking down at me and saying, what do you know? But you know, define your own battlefield and don't, when there's a fear of it, have a spider sense when there's the fear of missing out that's going on, and try to get away from that as soon as possible. And the most important thing was to figure out what you wanted, not what someone else wanted for you, or what other people were wanting, and then therefore, because of competition and the way we're genetically made up, that you wanted the same thing. You had to figure out I had to figure out what I wanted. I didn't want to go work for my mother, who had a government contracting firm. I wanted to be a value investor. It's very specific, and I was very lucky. And we're going over here, but trust me, if I didn't start in 1998, I don't know, that was a golden time to start, because there are a lot of value investors who started after the great financial crisis, like in 2013, 2012. I don't think I could have made it. It was just very lucky that a lot of things had to fall in place between deciding to go to Columbia, to starting a firm in 98, to making it through. So I hope that answered that question.
Thank you, that's very helpful.
Yes. If you have any questions, please ask Alex at my email list. I also, if you want to get on my value email list, get my email from Alex, and I'll put you on my value email list. And one more other thing, if you happen to go out to Columbia, there's a dinner, it costs $104. You have to pay online. There's going to be like usually 60 people there. There are a lot of talented money managers there. We ask for if you're new there and you'd like to make it a positive, if you'd like to make an impression, we invite you to pitch a 2-minute pitch with a 3-minute Q&A, very short. That's considered the entertainment. I will say, obviously, no promises. There are a lot of mentorships, a lot of jobs, a lot of opportunities that have come from those pitches. So, and again, hopefully you found this of value. Hopefully it helps your applied value class, and hopefully, you know, if the other judges come and speak, that you get some value out of that too.
Hey, James, is Stevens gonna be there, the recruiter? Steven Heisberg?
Yeah, he'll be there. Yeah, he's a
Yeah,
sponsor.
so.
Yeah.
Yeah, he's like this guy's like a legendary asset management recruiter. I actually talked to him for summer opportunities, because I was there last year. So yeah, I
He's a-
highly
he's a-
encourage you all to go.
He's a sweetheart of a guy, a very nice guy.
And I'll send that link around I'll send it to Alex and then,
Yeah, I'll
Yeah.
circulate around other stuff, James. If you have the dinner details, you can send it over to me.
Yeah.
I'll follow up with you.
it's 6 to 10:30 on May 4th.
Okay,
Yeah,
okay.
I tell you what, if you send me, if you, the student, like whoever
follow up.
on my email list, send me your email, I'll send you the invite. And also, there'll be a happy hour on that Friday after, the dinner's on Saturday and the happy hour to be determined is
Yeah.
gonna be.
And it's a very high bar, because if I recall, the guy who won last year pitched SMCI and the stock is up like 1,200%, so. It's gonna be
Yeah.
pretty hard. Yeah,
MSCI, that's a great, that's the Morgan's, that's the Moody's index business, right?
no, SMCI, super
Supermicro.
Micro.
That's
Oh,
the
okay.
That was that guy Alex who pitched that, the guy that worked for Verizon. I don't know if you remember him.
Yeah, well, there are gonna be a lot of stocks we missed, obviously, Nvidia and Apple and a lot- Netflix. So it's a very, as I said, it's a very humbling business.
Thanks for.
Thank you.
Thank you so much for inviting me. I appreciate it.
Thank you, James.
Hey, Tony, thank you, sir.
Yes.
See you later.
See ya.